When talking about finances, there are a lot of things to consider other than just keeping your money in your bank account. For instance, your money needs to grow and further expand its value. But before you withdraw that money, take the time to consider these first before you invest it elsewhere. For today's video, we will be showing you the top 10 things to consider before you make investing decisions. But before anything else, please like, share, and subscribe to our channel, Fortune Figures. Let's get started. Number 10. Evaluate your financial situation. Before you make any investing decision, sit down and take an honest look at your entire financial situation, especially if you've never made a financial plan before. Take an honest look at your net worth statement. On one side, list what you own. These are your assets. On the other side, list what you owe. These are your liabilities or debts. Subtract your liabilities from your assets. If your assets are larger than your liabilities, you have a positive net worth. If your liabilities are larger than your assets, you have a negative net worth. You'll want to update your net worth statement every year to keep track of how you're doing. The next step is to keep track of your income and expenses. Write down what you and others in your family earn and spend each month, including a category for savings and investing. Next, identify what you want to achieve in the short term and long term and write those goals down. Studies show that those who write their goals down have a much higher success in achieving them. Number 9. Avoid circumstances that can lead to fraud. Con artists know what appeals to people. If it sounds too good to be true, it most likely is. The higher the return, the higher the risk. There is no such thing as a no-risk investment. Be suspicious of individuals who tell you that you must act now. They tend to pressure you to do something until you become vulnerable enough to do it. This is a trick used by con artists to get you to part with your money. Spend time checking out the person touting the investment before you invest, even if you already know the person socially. Many scams are being promoted online now and via social media. Treat any investment opportunity you see advertised online with skepticism. It is best to understand a business and its products or services before investing. Number 8. Review your time frame and risk tolerance. Risk tolerance is the degree of variability in investment returns that an investor is willing to withstand in their financial planning. Risk tolerance is an important component in investing. You should have a realistic understanding of your ability and willingness to stomach large swings in the value of your investments. If you take on too much risk, you might panic and sell at the wrong time. Additionally, investing without considering risk tolerance is like sleepwalking to the edge of a cliff. Imagine investing in stocks without thinking about how you will react if their value drops. Automated investing services called robo-advisors and human financial advisors alike have clients fill out questionnaires to help gauge their risk tolerance. Number 7. Seek help from a professional. A financial advisor, sometimes known as a financial planner, is not just someone who helps with investments. Their job is to help you with every aspect of your financial life: savings, insurance, tax, debt, while keeping you on track to achieve your goals. The term financial advisor can apply to a variety of services, ranging from online robo-advisors to local, in-person traditional financial advisors. If you simply want help choosing and managing investments, a robo-advisor is a streamlined, cost-efficient choice. It's also good for those just starting out because robo-advisors often have low or no account minimums. But if you have a complicated financial situation or want holistic advice on topics like estate planning, insurance needs, etc., you might want to choose an online financial planning service or a human financial advisor in your area. Number 6. Think it through. How much do you need to invest? Another misconception about investing is that only wealthy people have enough money to buy stocks and bonds. However, the reality is that you only have $30 to spare. You can still invest it. Many brokerage accounts do not require a minimum investment amount, meaning that if you can only afford to buy one stock of a company, that's okay. Just remember to keep investing as you make money so you can grow it at an even faster rate. Number 5. Ask yourself why you want to become an investor. Before diving into how to invest, it is important to consider why you want to invest. Contrary to what popular culture might have us believe, achieving long-term investment success requires patience, hard work, time, and psychological discipline. Ask yourself whether spending your limited time and energy on investing is the right decision for you. Weigh it against other major commitments that you could pursue, such as completing a second major, learning a foreign language, working for a professor, completing internships, or being involved in athletic and community groups. Although it is possible to do many of these things in addition to your investment and college studies, there are limits to the commitments you can realistically maintain. Different investors have different motivations. Others are motivated by simpler goals, such as the desire to build financial wealth for themselves and their family. Giving serious consideration to why you want to invest will encourage you to remain diligently committed to your investment strategy during good times and bad times. Number 4. Invest in your knowledge. If you lack the time or resources to invest during college years, it is worth remembering that the best investment you can make is to develop your own knowledge. This principle holds true equally for those students who do have the time and resources to invest. Regardless of your chosen field of study, if you approach your investment education in a proactive manner, many industry professionals will be open to answering your questions and supporting you in your development as an investor. Another way to build your investing knowledge is to learn from the world's greatest investors. Extra classes, advanced degrees, and relevant certifications are all valuable investments. Take classes either in person or online and start now in building yourself. Number 3. Pay off debts first. If you're determined to begin investing, but still have several outstanding loans and credit cards with highest interest rates, you'll need to decide if you should be risking your money in the market. It's probably more prudent to pay off your debt first. Keep in mind that paying off your debt in full provides a guaranteed return on your money, which isn't the case for any investment. However, if you have a debt at super low interest rates, say 1% to 3%, you might want to consider investing instead of retiring the debt. If that seems hard to do on your own, you may want to consider a debt management program or debt consolidation. Number 2. Age is just a number. Certified public accountant and founder of Consolidated Credit Counseling Services, Howard Dworkin, said that younger investors have a tremendous advantage working in their favor: time. Just investing a modest amount of money today can lead to big returns down the road. This means that it is strongly advisable to start investing as soon as you can. Take advantage of the power of compounding. The younger you are when you begin investing, the more time you'll have for your initial investments to grow and increase your personal wealth. There are investments you can make during each decade of your adult life to take advantage of the power of time. If you are in your 30s, you have 30 or more years to profit from the investment markets before you are likely to retire. If you can handle the volatility of stock prices, now's the time to invest aggressively. If you're late to the saving and investing party, you can catch up in your 40s by putting the pedal to the metal and making some lifestyle trade-offs. And last but not the least, number 1, determine the right type of investment for you. The investment landscape can be extremely dynamic and ever-evolving. But those who take the time to understand the basic principles of investments stand to gain significantly over the long haul. Investing can be a daunting prospect for beginners, with an enormous variety of possible assets to add to your portfolio. That is why investment education is essential. It may seem like common sense for people not to invest in things they don't understand. Unfortunately, it happens a lot. Evaluate first your comfort zone before taking any risks. All investments involve some degree of risk. If you intend to purchase securities such as stocks, bonds, or mutual funds, it's important that you understand before you invest, or you may end up losing some or all of your money. Additionally, know what your means are and only invest within the bracket. It is best to start your preferred investment and stay away from securing loans you are uncertain whether you are able to pay off at a later time. And lastly, survey your entire financial situation. Take into account your present financial needs as well as any future needs that you might be aware of. This way, you will have a good overview of what financial status you are in. And that's it for today, guys. We hope you enjoyed today's episode. Do you have any personal tips you can share with us, like the ones from the video? Comment down your answers below because we would love to hear it from you. Please don't forget to like, share, and subscribe to our channel, Fortune Figures, to keep you posted on our latest and trendiest updates. Thanks everyone, and I will see you again next time.